Welcome to the eMortgage Management Hour, a straight talk show designed to give you the truth about mortgage financing in the greater Tampa Bay area. The views and opinions of your host, Scott Pendleton, and his guests do not necessarily reflect the views and opinions of WHNZ or its advertisers. And now, your host, Scott Pendleton.
How's everybody doing today? I am Scott Pendleton. Welcome to the eMortgage Management Hour, where E is for education. eMortgage Management is a licensed mortgage banking firm, NMLS number 2926, and all our contact info can be found at tampabay.emmloans.com. Quick overview about eMortgage Management. We're a mortgage banking firm. We specialize in residential mortgages. That's what we do. We're not a bank. We don't take deposits. We don't sell CDs. We don't sell other financial products. All we do is mortgage. We do it, and we do it really well. We focus on one thing, and that's getting loans closed and closed on time. We like to focus primarily in the purchase market, but we'll happily talk to you about a refinance anytime that you'd like. You can always, once again, contact us at tampabay.emmloans.com. All our contact information is on the website, or you can call us directly at the office. The phone number is area code 813-517-0795. Really excited. Got a couple of great guests today. In segment one, I've got Patrick Sheridan, who's a newer member of our loan origination team. Patrick's going to be coming aboard with us to discuss one of the main topics we're going to talk about today. We're going to talk about buy versus rent. We're going to give you some real-life examples of loans we closed, talk a little bit about, what the difference was in payment. We'll talk a little bit about down payment and things of that nature. So, maybe some of the reasons and some technical reasons, that you may want to buy versus rent, and just to put some thoughts in your head. In the second segment, I'm also very excited to have Brian Miller. Brian's with Keller Williams South Tampa, the Miller Property Group. Brian and I have known each other for a long time. Brian's been a full-time professional realtor here in the Tampa Bay market for quite a while now. One of the true top professionals in our market. I can say with utmost confidence that he is great at what he does. So I'm excited to have him come in during the second segment. He's going to talk to us probably a little bit more about rent versus buy, and also, maybe some other topics may arise from there. So with that being said, before we get into the topic full bore, I do want to introduce Patrick Sheridan. As I said, Patrick just came aboard with us in the last couple of minutes. So, Patrick, tell us a little bit about yourself. What made you decide? I know, kind of backing up a little bit, Patrick worked for a few big banks, and as I said in the introduction, we're a direct lender. So, kind of tell me about yourself and maybe some of the reasons you decided to step away from some of the big banks and come with more of a boutique-y, direct lender type of environment.
Well, thanks for having me on today, Scott. My name is Patrick Sheridan. I have 18 years of experience in the mortgage industry. Originally from Michigan, but I've been here 28 years, so I kind of consider myself a Floridian.
I'll give you that.
Thank you. I've earned it. And I kind of got into the mortgage industry by fluke. I was a trained firefighter paramedic and found it difficult in the early 90s to find a job. My sister was in banking, and I took an entry level into banking. And within 6 months of being a teller in banking, I was in a mortgage department. So after being in the mortgage department for several months, the bank I was with, Barnett Bank, was sold to Nations Bank and then Bank of America. There's where my big bank experience comes in. Spent 7 years with them and learned a lot, learned how I didn't want to do customer service, but also learned a lot of the technical side of mortgage loans. Then went on to be a loan originator, and I've been originating loans since 2003.
That's great. Well, we're happy to have you on the team. I know you do a great job for us. One of the things we talk about a lot on this show is the education aspect of the mortgage process. And we talked a little bit about this on one of the previous shows. You're seeing a lot of information out there, a lot of news, a lot of advertising for, digital mortgages and how you can do things online now and how everything is automated with the mortgage process, or can be. And trust me, I think technology is great. We use it. It's a benefit to us. It helps us speed up the loan process, the way that we can process a file with automation. It's fantastic. But I never want to lose the personal touch, knowing that you as a consumer, as a borrower, can pick up a phone and there's going to be somebody on the other end of that line that can explain the whys behind what the underwriter's asking for. And I think that's what's lost sometimes in mortgage banking. Everybody wants to, email and text. And sometimes you just got to pick up the phone and have a conversation. And that's why we really pride ourselves on, making ourselves available. We do answer our phones in the evening. We do answer our phones on the weekends. I'm calling a client tonight at 8 o'clock because that's when he's available for me to take his application. So you do what you got to do. But we want to make sure that we're available. So when you have those questions, you can pick up the phone and somebody's going to be there to explain the whys behind the things that we're asking for. Because the mortgage process can be very cumbersome. It can be very convoluted. We ask for a lot of documentation. Trust me, if it was up to Patrick and I, we wouldn't ask for so much documentation. But we do have underwriters that we have to, provide that documentation for. So it's very important that you as a consumer understand the whys behind why we're asking for the things we ask for, and get it to us in a timely manner. So with that being said, I do want to get into kind of our topic, which is buy versus rent. The question becomes, if you're out there and you're renting a house right now, obviously the market is changing. We're definitely seeing rates increase, rental rates increase. Mortgage rates, luckily, are staying pretty low. Although over the last couple of weeks we have seen a little bump in mortgage interest rates. We're still at historic lows if you look at the history of mortgage rates. The question that comes to hand, is it better to buy a home? And one thing that I recently read, a handy rule of thumb would be to multiply your monthly rent by 240. So, for example, let's say you're paying $1,200 in rent. If you take $1,200 times 240, we're thinking months, of course, 240 months, your investment into that rental property would be $288,000. And it may not be the exact property. Maybe you go from rental to rental to rental, but you're going to be paying rent somewhere if you don't own a home. So just figure over 240 months, paying 10 years, you're paying $288,000. If you can buy a house for less than that, then buying is a better option. So you just got to do some simple math. On our website, tampabay.emmloans.com, under the resources tab, we have a rent versus buy calculator to help you break down the numbers in more detail. I actually found a rent versus buy calculator online just the last couple of days when I was doing a little bit of research for the show. That was a little bit, to be honest with you, I think a little bit better than our rent versus buy calculator. And what this does, and what I liked about it, is it gives you an example of a sale price with a down payment, but it also gives you the example if you took that money instead of as a renter and invested it in the market, where you would be. So I just ran a quick scenario on that calculator, and basically what I did is I put in a $200,000 purchase price with 5% down, a 30-year term at a mortgage interest rate of 4.25%. Pretty standard deal in our market. Our average loan size in this market typically runs in about that $200,000 range. That's a pretty standard. Just using some real basic numbers. In this example, we use $6,000 for closing costs, $2,000 in annual maintenance on the property, $2,760 in property taxes, $2,760, and $1,000 a year in homeowners insurance. For the home value, we're saying that we think that the values are going to appreciate on that home on average about 4% a year, which in my opinion is a healthy appreciation. If you go back to 2002, 2003, we were seeing appreciation of 10, 15%. And that's why we got in the mess that we got into. It was unrealistic, and everything imploded. So I think 3 to 5% appreciation is a healthy rate of appreciation. So I just took it down the middle and used 4%. In this scenario, we said that the person had a 25% tax bracket. So it takes in your tax bracket into, and then a capital gains rate of 20%. So if you were to sell the property and had any capital gains taxes, we took that into the calculation as well. So we're comparing that to a rent assumption of $1,400 a month, and that you're able to take the money that you would have invested in the real estate and put it in the market and earn 8%, which is pretty aggressive. If I knew I could if I could take my money and put it in the market and be guaranteed 8%, I'd jump on that right now. So in that scenario, you're basically net spend over a 7-year period. And the reason I use 7 years, we see in our industry the average is most people stay in a home or a mortgage specifically from about 7 to 10 years, 10 being maybe on the high side, really probably more like 5 to 7 years. At that point in time, the people are either moving, they're moving up, moving down, or they've refinanced out of the loan for various reasons. So the average is about 7 years that a mortgage stays in play from what we're seeing. So in that net scenario, net spent on the purchase over that period of time was $66,186. Net spend on the rental was $119,380,000. So in that scenario, the buy is a much better option. You're spending, over $40,000 less over a 7-year period. That's $40,000 real money in your pocket that you can help pay for college and whatever, or invest in a new, much bigger home the next time around. So, that's just kind of one example. When we talk about things like this, Patrick, and I'll let you chime in a little bit, I know you're very, very conscious and you find it very important to really educate the borrower as well. Give me your take on the rent versus buy in the education process, because we've talked about this a little bit.
Yeah, well, I'll start with find a qualified loan officer and a qualified real estate agent. That's the most important thing. A buyer wants to have education from both sides. They need education on the loan, what's available to them, and then they need education on the real estate side as to what's available for them to purchase. When it comes to rent versus buy, again, I spoke with a young lady this morning who's renting for $1,200 a month in the Soho area, and it's a one-bedroom apartment. So it's tiny. It's $1,200. It's in a great location, but it's $1,200 a month. That's about the cost of a $175,000 home with an FHA purchase at today's rates, and just throwing in some estimates for taxes and insurance.
Yeah.
So, I mean, obviously there's a lot that goes into it. There's a tough real estate market in that price range. But rents, as we know in Tampa, are sky high right now, residential and commercial. They're throwing up more high-end apartment buildings left and right, and sometimes these rents go in excess of $1,800 a month.
Yeah, absolutely. Well, when you brought that up to me earlier when we were talking about the show, I've got a client right now that's purchasing a condo, Indian Rocks Beach. Now, it's a good deal on this condo. He's actually been living in the condo. So here's kind of the interesting thing. The guy's been living in the condo for the last year and a half. Long story behind why he was renting, but he was in a long-term contract for the last year, knowing that he'd be able to purchase towards the end of this year. So he's paying $1,760 a month in rent on this property, and it includes he's also covering some of the HOA fees on top of that. So I'm looking at it today, and I was like, let's look at that scenario. This guy's buying this property for $191,000. Now it's not on the water in Indian Rocks Beach; it's off the water a little bit, so he's getting a pretty good deal on the property. It's a condo, from what I recall, it's a 3-bedroom, 2-bath, pretty nice place. But the real deal is his new mortgage payment in that scenario is going to be $1,543. That's with a $225 a month homeowners association or condo fees. So he's dropping his payment by over $200 a month by purchasing the property. So, it's a win-win for the guy. He can't wait to close. And he's only putting 5% down. He's doing a conventional loan, 5% down, and it's a pretty clean deal. And we're going to get into some more real specifics. I've got some good scenarios that we'll get into a little bit maybe in the second segment. One of the other things in my research I was looking into, here's some other things to think about. It's your property when you purchase a home, and that's the other thing. I mean, I've rented a lot over my lifetime, and I've owned my current home for almost 11 years, and I owned a home prior to that. Before that, I was, I've been in the mortgage business for about 16 years. I worked in a whole nother industry prior to that, and before that, I was active duty Coast Guard when I was much, much, much younger, and I moved a lot. So I was a renter. The one nice thing about owning your property is you can do with it as you wish, and I think sometimes we lose that. When you're renting a property, you're restricted by that lease agreement. the type of pets you can have, what color you can paint the walls, and modeling restrictions. There's not a lot you can do with the property. You can put your furniture in there, and that's about it. Most landlords don't even want you painting the walls. So, I've always had pets. I'm the type of person that likes to have dogs. My wife likes cats. So, I've got a house full of animals. I can have as many animals as I want in my house. Nobody can restrict that. You know what I'm saying? So, the ability in the capacity to do with the property as you wish, from a modeling, paint color, no pet restrictions is great. Not having to move as often means really, I always noticed that every time I rented a new property, it was kind of a different configuration. So I had to buy different stuff to meet that property. Like I said, I've owned my house for almost 11 years now. We bought new furniture when we moved in the house. I haven't bought any new furniture in the last 11 years. I haven't needed to. It's the exact same house. We haven't remodeled the home, so I haven't had to buy new stuff as much. It saves you money just in that standpoint. You move into a new apartment, maybe it's a little bit bigger, so now you got to go get some different furnishings. And that's one less thing, one less expense when you buy a house. You move in, you buy your stuff, you decorate it, and you're done. Mortgage interest, and I think a lot of people forget this. Mortgage interest is tax deductible. So, for example, on a $175,000 mortgage at a 4% interest rate, at a federal tax rate of 25% again, your first year tax savings in that scenario is $2,173. I went and did another online calculator and figured that out based on a 25% tax bracket. So, in that scenario, you're saving a couple of grand a year just in income tax. That's $180 a month, basically, that you're saving. That's real money. That's money that's going in your pocket at the end of the year. So it's a great tax deduction. And most of us need as many tax deductions as we can possibly get. A fixed rate mortgage doesn't go up, So if you buy a house, which most people are these days with a 30-year fixed mortgage, the nice thing is your rate's not going to change. Your payment's pretty much always going to be the same, unlike rents. Rents go up. As the market increases and the market improves, your landlord's trying to bump that rate every year. He's trying to bump that rental rate. If he can get an extra $50 out of you or an extra $100 for, and you don't want the hassle of moving again, so you're like, all right, I'll pay an extra $50 or an extra $100 a month and stay in the property just so I don't have to move, just so I don't have to box up all my stuff again and move it again. That's something that's really exciting. So you've got that scenario where you've got a 30-year fixed mortgage. Your principal and interest payment never changes for 30 years. It's always the same. It's amortized over 30 years. That's the way an amortization schedule works. Now, that doesn't mean your property taxes and your homeowner's insurance can't change, but you also have the capacity to shop the homeowner's insurance around every year. I think a lot of people forget that, homeowners. I'm not as guilty of it because I deal with this on a daily basis, but I see this when I do refinances all the time. I look at what people are paying in homeowners insurance, and I'm like, man, you're paying a lot in homeowners insurance, and a lot of times I can get them quotes for several $100s less than what they're paying on a yearly basis. So, if you are a homeowner out there, I encourage you when that homeowners insurance premium comes due every year, even though it's probably getting paid out of your escrow account, shop it around, see if you can get a better deal. There's always that opportunity out there. So, that's another big factor. That 30-year fixed interest rate never changes. Kind of moving into that, you've got a lot of different, loan products out there, and we're starting to see the market change a little bit with the type of loan products that we have available. So what we're seeing for most first-time home buyers is we're seeing FHA loans. So the typical FHA loan would require a 3.5% down payment. So on a $100,000 purchase, you'd be looking at putting $3,500 down. I encourage anybody that's renting now that's thinking about purchasing a home, start really saving that money. Start putting that money aside as soon as you possibly can. The nice thing about FHA loans, and we've talked about this several times, FHA loans are not as credit score driven as conventional loans. So if you don't have perfect credit, that's kind of what the Federal Housing Authority was thinking of when they designed this loan program. It's there for those individuals that are maybe first-time home buyers. You don't have to be a first-time home buyer. or maybe don't have perfect credit, where you're going to be able to get a rate that, to be perfectly honest with you, is probably going to be on average right now about 0.25% to 0.375% lower than a conventional loan. So FHA rates are lower than conventional rates typically. They're federally insured loans. So what are the negatives of an FHA loan? When you do have an FHA loan, you're going to pay monthly mortgage insurance. Probably the only real big negative about that today is it's for the lifetime of the loan. That's something that changed a few years ago. And to be perfectly honest with you, I firmly believe in the next year to 2 years, FHA will back off on that. I think they will eliminate that rule. It didn't used to be the case. It used to be you had to keep the mortgage insurance for 5 years. Patrick, what do you think of that? I really think they're going to back off on that. They've started to come down on that a little bit.
Honestly, I haven't given that much thought. When they change rules like that, I kind of, in my opinion, I just take it as that's the new rules.
Yep.
But they've come back on the mortgage insurance cost, the monthly cost. It'd be nice to see them bring down the upfront cost, and then possibly give those buyers an option to get rid of that mortgage insurance without the expense of refinancing to a conventional loan, because it's expensive, very expensive for the buyers or homeowners.
Yep. So, one of the other things we talk about, and when we talk about FHA loans, obviously we're talking about interest rates. One thing I just mentioned earlier in the show is rates have crept up a little bit here over the last couple of weeks. And kind of what I'm seeing, Patrick, I don't know, you can kind of chime in and give me your opinion. It seems to me like rates have been, in the last 2 years maybe, they've been very, very cyclical, almost like a roller coaster. They seem to kind of go up and down in about 0.25% range.
Exactly.
So on a conventional loan, let's say the rate today is 4.25%. It seems that 4 to 4.25 seem to be the sweet spot for conventional loans. And the reason I ask you is because you've worked for a couple of different banks over the last year. I've only really been with the same company. I know with us, I'm seeing the rate kind of go up and down in that 0.25% range. Now, 0.25%, nobody wants a little bit higher interest rate. Everybody wants the lowest rate they can possibly get. But really, 0.25% doesn't make a huge amount of difference in your payment. I really think this will continue to happen for a while. What are your thoughts on that?
Well, yeah. I mean, if you look at the 2 or even a 3-year line, it's flat. For the long term, 3 years, it's just flat. The interest rate's gone up, like you said, or down 0.25%. But as you know, once the Feds start to raise their rates, then you're going to see that rate, going up higher. It's going to be 0.375 of a point or half point, or we're going to even see bigger increases than this quarter up, eighth down. It's like I said, it's a flat line.
Yeah,
0.25% of movement in our industry. At least I don't think of that as a big move in interest rates. You probably don't either.
No.
You get up towards a half, 0.75 of a point, that's when you should really start to notice that rates are increasing. It's not just day-to-day market fluctuations of what's going on in the market that's moving the rates. It's a true driving force that's going to last a while.
Yeah, and there's so many factors that have an influence on interest rates. When we look at this, we're spoiled, really, and young people have no idea. I mean, our parents were paying double-digit interest rates. It wasn't uncommon to get 11, 12% on a 30-year fixed mortgage not that long ago.
Late 70s, early 80s.
Yeah, late 70s, early 80s. Rates were so much higher. When if you went to your grandmother or somebody that bought a house in 1978, and said, "Hey, I'm looking at an interest rate of 4 to 5%," they'd be like, "Holy cow, it's amazing!" It just blows their minds.
My dad wouldn't buy a house in that time frame, just due to interest rates. He wasn't paying a bank. He didn't use credit cards. He didn't use credit, and he wasn't going to pay 15%. And we rented. So that you go back to rent versus buy. Maybe 1978, 1982. It might have been better to hold tight and rent for a while until rates came back to reasonable time.
Yeah. And I really don't think we'll ever see rates like that again. Not in our lifetime. Not never say never. So we're going to take our first break. We'll come back in just a few minutes. In that segment, we're going to talk to Brian Miller. So from there, we're going to kind of continue our discussion on buy versus rent, and I'm going to give you guys some real life examples on deals that we've done, so you can kind of see the numbers, or hear the numbers, I should say. All right. So we'll talk to you here in just a few.
And now, back to the eMortgage Management Hour and your host, Scott Pendleton.
Welcome back. We're going to kind of continue our conversation about buy versus rent. Also in this segment, we've got Brian Miller with Keller Williams South Tampa, the Miller Property Group, going to come aboard with us here in just a few as well. So as we were kind of talking about the buy versus rent subject, you know, I always like to use real-life examples. I think most people want to know, Give me something real. What? Give me some deals you've done. So, what I like to do from time to time is kind of look at some of the loans we've closed. Let's just say in the last month, so you guys can kind of see what maybe some of the prices are in certain areas. So, kind of on that subject, I like to give you the city. So, for example, I've got a property that we just did a closing on as a purchase in Tarpon Springs. Most people in the area know Tarpon Springs. Nice area, good housing prices over there. So this deal was an FHA purchase. Purchase price was $149,000, and the buyer put 3.5% down. So in that scenario, $149,000 purchase, 3.5% down. Their down payment was $5,215. Now, one of the nice things about FHA loans is you can negotiate into the contract for the seller to pay your closing costs. Which is always a nice option. So you could literally get into an FHA loan with just your down payment of, in this scenario, $5,215. So the payment on this property, these people were paying $1,040 a month in rent. Their new payment is $977.94. So they dropped their payment, and they were able to buy a 3-bedroom, 2-bath home, just over 1,400 square feet in Tarpon Springs. You know, nice, good starter home, first-time buyer, young couple, 3-bedroom, 2-bath, you know, got maybe 1 or 2 kids, plenty of room. You know, not a huge place. It's not a mansion or anything like that, but just to give you kind of a feel for the area. We also just did a purchase in Land O'Lakes. This property, also FHA financing, a little bit more expensive house. So this property was $199,900. Once again, they did the 3.5% down payment, so their down payment was $6,997. They were paying $1,200 a month in rent. The new payment was $1,377, so their payment went up a little bit in comparison to what they were paying in rent, but they got a 4-bedroom, 2-bath house with a 2-car garage that's over 2,000 square feet. That's a pretty good size home. You know, I think the average size home, and maybe Brian can chime in on this here when we get into it just a few minutes. I don't know what the average size home is here in our market. We'll see if Brian knows here in a minute when we get to him. But they got a 4-bedroom, 2-bath home, 2-car garage, and their payment's $1,377. Not a bad deal. Just also did a closing in Riverview. Now, this person was a VA borrower. You know, I'm a veteran of the United States Coast Guard. We love working with vets. We do a lot of VA loans here in our area. Now, here's a great thing about this. $207,000 purchase, VA loan, 0% down. A lot of times when we do VA purchases, that borrower is walking into that property with no money down. Majority of the time when we go to closing, because most of the time when you purchase a home, you put up an escrow money deposit, let's say $1,000. And I'm pretty sure this scenario worked out about this way. This borrower put up, I believe his escrow money deposit was $1,000. When he got to closing, because the seller, through a seller concession, paid the closing costs, he had 0% down. He actually got money back at closing. The title company handed him back his $1,000 escrow money deposit. Thank you very much. Congratulations on your new home. So this guy was paying $1,500 a month rent. He bought a $207,000 house. His new payment's $1,409, so he dropped his payment by about $100 a month. He's got a 3-bedroom, 2.5-bath, 2-car garage home, beautiful property in Riverview. Riverview is a very affordable area, a lot of military, Brandon and Riverview because it's so close to McDill and it's an easy commute. 1,897 square feet. Really, really nice property. I looked at the pictures on the appraisal before I came today. So, you know, if you are a veteran and you haven't used your VA loan, take advantage of it because it is absolutely the best product in the market. Another great thing about VA loans, there is no monthly mortgage insurance. So that's one of the things that really helps keep that payment low. Where on an FHA loan or a conventional loan, if you're not putting at least 20% down, you are paying a monthly mortgage insurance premium. Another property that we just closed, this is a conventional loan, Safety Harbor. I don't know if you're familiar with Safety Harbor. Beautiful area. It's just Safety Harbor. If you haven't been to Safety Harbor in a while, you need to go check it out. It's just cool little fun little area. There's all kinds of nice little restaurants and bars. You can walk around Safety Harbor for hours, and it's really neat. My wife and I like to go down there and just maybe have some cocktails, some oysters, something like that. So there's some cool little spots down there. So this was a $326,000 purchase. Now this particular borrower did put 10% down, so $32,600. Their payment is $2,016, but for that they were able to get a 4-bedroom, 2.5 bath, 2-car garage, a pool, all updated. I saw the pictures on this one as well. These people are actually friends of mine, so I'm just waiting for my invitation to the party. It should be in the mail any day now. 15 square feet, so a nice size home. And it's all updated. Everything in the house is basically brand new. It's a beautiful, beautiful property in Safety Harbor, which if you haven't been to Safety Harbor in a while is really, really fun. Another one that we just did in Palm Harbor. I'm trying to give you guys kind of a range. So from Tarpon Springs to Land O'Lakes to Riverview to Palm Harbor. Palm Harbor, if you don't know the Palm Harbor area, also a very, very desirable area in Pinellas County. Great schools, probably one of the best school districts in our area, maybe second to the Plant District in South Tampa. Plant High School is probably one of the top. You've got some really good high schools over in the Palm Harbor area as well. Purchase price on this property was $299,500. Once again, they put 10% down, so their down payment was $29,950. Payment came out to $1,882. This was a townhouse, by the way. Payment $1,882, but it's a 4-bedroom, 2.5 bath, 2-car garage. Does have a community pool. Square footage of 2,174, so 2,174 square feet. Once again, great property in Palm Harbor in a great school district. So, something to kind of think about. And, once again, we're here to lead you down the path of making the best decision for you as a consumer. So, you've got, scenarios here where they did FHA financing. You've got scenarios here where they did conventional financing. We got a guy that did a VA loan in these couple of examples that I used today. When you contact us, if you go to our website, tampabay.emmloans.com, or you call us at our office, 813-517-0795, we're available and eager to answer your questions. We're here to educate you as a consumer. I can't tell you if an FHA loan or a conventional loan is the best option for you until I have a conversation with you and I look over your credit and I look at your overall job history and income and how much debt you have to the amount of income you have. Once I put all those factors together, then you and I, or Patrick, or Raul, or any of our loan officers can have a conversation and make a determination of what's the best option for you financially as a consumer, because it's not my choice. I'm not going to tell you what loan you have to pick. You're going to make that determination. I'm here to educate you. I'm here to give you the whys, the pluses, the negatives, and so you clearly understand when you make a decision, why that was the loan product for you. Now, with that being said, the caveat to that is sometimes you only qualify for one type of loan. There may be a situation where you don't qualify for a conventional loan, but you do qualify for an FHA loan. For example, FHA loans are much more liberal when it comes to overall debt-to-income ratios. So, if your amount of debt to your income is a little high and maybe you don't qualify for a conventional loan, there's a good chance that you would qualify for an FHA loan. Maybe you don't have 5% to put down. You only have 3.5% to put down. Now, with that being said, there is a conventional loan product out there that only requires 3% down. So there's always that option as well. You've got the VA loan. Not everybody qualifies for a VA loan. You have to be a veteran. There's specific rules to qualifying for a VA loan. You have to get a certificate of eligibility. If you qualify, you qualify. that's really probably the best 100% program, 100% financing program out there. Now, with that being said, USDA does have a zero down 100% financing program as well, but it's only for rural properties. The issue that we run into here in the Tampa Bay market is we don't have a lot of rural properties around here. We're pretty suburban. South Tampa, Pinellas County, unless you get up into like Hudson, way east Tampa, some of Riverview, parts of Brandon used to be considered rural, but they changed the maps. They eliminated a lot of Brandon. There are some caveats to that, some cases where you'll find the rural properties. Now, if you're in the outlining areas, of Tampa Bay, please don't hesitate to give us a call. We do a lot of USDA loans. I'm doing one for a customer right now. It's a great loan product. And the rates are very comparable to FHA and VA, which are, like I said, typically lower than conventional loans. So, the moral of the story is there's products out there available for you. And then we're starting to see the market change a little bit as the market is improving. And we're seeing some what I'll call non-prime loans coming back into the market. So if you've had a short sale recently or a foreclosure recently or a bankruptcy recently and you've got down payment money, we do have some loan programs out there. I've got an investor right now that'll do 1 day out of bankruptcy, 1 day out of a short sale, 1 day out of a foreclosure. It does require a larger down payment. Typically, these programs require at least 20% down. I'm not going to lie to you or try to give you, lead you down the wrong path. The rates are a little bit higher. There's more risk in these loans. Understand, everything is risk-based in the lending industry. It's how much risk the investor perceives is how they're going to come up with their interest rates. So the same thing with conventional loans. We start talking about conventional loans. The higher your credit score, the better interest rate I can get you. If you've got a 780 credit score, you're going to get the best rate out there that's available, assuming you qualify. If you've got a 680 credit score, because of risk factors and what are called loan level pricing adjustments on conventional loans, it's going to impact your interest rate a little bit. So on a conventional loan, a guy with a 680 credit score is not going to get the same interest rate as a guy with a 780 credit score. But once again, we're here to educate you, the consumer. We're available to answer those questions and, once again, explain the whys and give you the details of why you, with a 680 score, maybe aren't getting the same rate that you're seeing on Yahoo.com, because the rates that you're seeing online are always based on 20% down, 740 or better credit score. They're trying to lead you down the path of calling them. So with that being said, I don't want to take up too much time. I want to jump in and introduce Brian Miller, Keller Williams, South Tampa, the Miller Property Group. As I said before, and you've probably, if you've ever listened to this show, you've heard me say it a lot. When we do what I'll call a realtor spotlight, I only bring in full-time professional realtors that do this as a career. If you're out there and you're working with somebody, you want to purchase a home, sell a home, I encourage you to vet that person and make sure they're a full-time pro. I'm not saying that your sister-in-law that's a school teacher during the day and also sells real estate on the weekend is a bad person. I'm just saying, if you're going to sell a piece of real estate, it's probably the most expensive thing you're ever going to invest your money in. I would encourage you to go hire a full-time professional, because I know for a fact Brian does a lot of training. He goes to seminars. He's constantly educating himself to improve and get better at what he does. So with that being said, Brian, welcome to the show. Tell us a little bit about yourself.
Hey, thanks, Scott. I appreciate you having me on today. I have been down in the Tampa area since 2002. I moved here from Minnesota. Anybody that's been in Minnesota in the winter can tell you, they'll know why I'm here now.
That's right. But, you're a Vikings fan. I almost forgot about that. You guys are actually having a good season, though.
For once. Yeah. So, like I said, came down here in 2002, bounced around a little bit, try to figure out what I wanted to do with my life. And in 2005, decided real estate was the route I wanted to go. I've been doing it full-time since then. And so I've seen the ups and downs with the crash of the market and all that kind of good stuff. So been doing real estate ever since, and really enjoy it, and really enjoy getting to work with people and help them with such a large investment.
That's awesome. Well, when we were talking just a little bit ago, and I was giving some of those examples, I was kind of saying maybe you could help us with some market statistics.
Sure.
Maybe some what is, I don't even know what the average size home is in this area. I don't sell real estate. I finance real estate. So
Correct.
I'm not out there looking at properties. That's what you do. So give me some statistics. What's going on in the Tampa Bay market?
Well, to touch on, your average size home, that's going to it's going to vary a little bit on, the area of town you're in. If you're in South Tampa, $250,000 isn't going to go as far as it's going to go, like you said, in Riverview, where it's going to get you that nice big house.
Right.
So a lot of that has to vary on where you're looking. But as far as market statistics, I've got some stuff from the Greater Tampa Association of Realtors, and what I have here is kind of what's happened over the last year as far as inventories.
Great.
Our inventories have gone from September of last year, we had about a 4.5-month supply, to September of this year, we have a 3.4-month supply. And for those of you that are not familiar with how a real estate inventory works, what that means is if nothing hit the market in the next 3.4 months, everything would be sold. We would have nothing left. And the experts, quote-unquote experts, say that a 6-month inventory is a balanced market. It's not a buyer's market. It's not a seller's market. Anything below that number is considered a seller's market. So we are in the midst of a seller's market right now.
Well, and I can attest to that because I know when I'm seeing my buyers that I pre-qualify, they're out there looking at these properties. If they don't jump on that property, the minute it seems like that it hits the multiple listing service, it's gone. It's especially in the desirable areas, the Palm Harbors, the South Tampas, places like that. I'm seeing properties move so fast. I've got buyers out there that are chomping at the bit to buy a house, but every time they make an offer, they're getting beat out. There's multiple offers, so I can attest to that. I'm seeing it myself on my end.
Yep, and along with that, we've seen the prices coincide. As those inventories go down, it's your classic supply and demand.
Sure.
And our prices have gone up quite a bit. The average sales price in the Tampa Bay area, which includes Hernando, Pasco, Hillsborough, Pinellas counties, has gone from $199 up to $222. So we're up about 11.3% year over year.
Wow, that's a big increase. Well, the good news is rates haven't increased that much. So
correct.
Rates are staying low, which keeps things affordable. So that's the good news there. We saw a tremendous downturn in the market several years ago. I think it's healthy that we're seeing the things that are going on today. But I always get a little nervous because I firmly believe if we can keep things at about a 4 5 6% appreciation, I think in the long run it's a healthier market.
Agreed.
So
agreed.
You got any other hot tips for us? Any other hot statistics?
Just based on you had talked about how things are moving so quickly. The average days on market has also decreased by about 7.5% down to 49 days on market. And I can tell you that number is a little bit skewed because if your house is priced correctly, it's not going to be on the market for 49 days.
No.
That's taking into consideration these houses that are overpriced and they sit on the market for 6 months. But if you're pricing your house right, what I'm seeing is within 30 days you can have your house sold at a pretty good price.
Right. Or what about the guy that's got his house on the market? I see this sometimes. They've got their house listed on the market. They've kind of overpriced it on purpose because they're trying to avoid a foreclosure.
Correct.
I see that sometimes.
Yes, and some people, unfortunately, some people are in the position where that's the only option they have.
Yeah.
But that's a great lead into the next stat I have is foreclosure sales are down over the last year, which is great, and it's for a healthy market. The short sales are down about 25%. Our bank-owned foreclosures are down about 23%, and our traditional sales are up about 31%. So
that's awesome.
That's a very healthy thing for the real estate market, and it's to me, it's a sign of good things to come.
Yeah.
Nobody likes to have all those foreclosures and REOs out there unless you're an investor with really deep pockets.
Yeah. Well, speaking of deep pockets, I know one thing that I'm seeing a lot, which is not good for my business. I know you probably are seeing it as well. There's a lot of cash buyers out there.
There is.
Yeah. Do you think most of those cash buyers are coming on the investment side, or I'm still seeing a lot of even owner occupied?
There are owner occupied, but in my experience, most most of the deals I do with cash are investors. You will get the cash deals once in a while, which, like you said, no fun for you. It's great for me, but
yeah.
But a lot of people, that's not reality. The majority of people don't have $200,000 just to go throw down on a house.
Right.
But you do see it, and I don't think that that's a bad thing either, because it shows that the economy as a whole is recovering.
Absolutely.
We're going through some pretty tough
Well,
times.
it's not a bad thing, but I would encourage people to use other people's money. OPM. Remember, rates are low. Even if you do have $250,000 or $300,000
right.
to put down on a property, maybe keep $150,000 of it aside. Finance the other $150,000 at 4% interest, and see if you can go do better in the market, because I bet you can.
Yep.
So,
and money is, like you said, money's dirt cheap, and leveraging is a beautiful thing.
Absolutely. So on the buy versus rent topic, give me your 2 cents. What are some of the things you're dealing with the home buyer and the home seller out there? Where
Sure.
I typically only deal with the home buyer.
Sure.
Give me your take on that.
Okay, first of all, as a buyer versus a renter, as you touched on before, the first thing you want to do is you want to educate yourself and make sure that you're doing the thing that's best for you, and that you're, not going to put yourself in a bad position down the road.
Mm-hmm.
So, to me, if you have the down payment money and you're not drying up all your savings, and you can get the house you want, there's not many instances where I would suggest renting over buying. There are a couple. And the 2 instances where I would say maybe renting versus buying is if you're new to the area and you have no idea where you want to live. Tampa Bay is a big area.
Yeah.
Do you want to be in St. Pete? Do you want to be in South Tampa? Do you want to be in Riverview? Do you want to be in Land O'Lakes?
New Tampa. Yeah,
You've got to find that out first, because you don't want to buy and 6 months down the road say, I hate where I live. Yeah. If you're renting, that's one thing. You can get out. So that's one. And then the other that I see people renting, and I think it's a good idea, is if you're unsure about the time you're going to be in the area. If you don't know, if you think you might get a job relocation within a year, don't buy. But other than those 2 situations, and not having the money for the down payment that you need, and that would be a conversation that would have with you, go over the finances, things like that. I don't see a reason not to buy. Money's cheap, and why not make some appreciation rather than just renting.
Yeah, and I, you know what, I agree with you wholeheartedly on both of those points. I think those are probably the two scenarios where I would agree with you. And if somebody came to me and they told me that, I talk to clients all the time, people moving new into the area. Mm-hmm. I encourage people to rent in that situation on a regular basis. Yep. Figure out where you want to be. Call me back in 6 months. See if you could do a short-term lease. Even if you have to sign a 1-year lease, it's not the end of the world. I'm going to be here next year. Let's have a conversation about 4 or 5 months before you're ready to buy. I always encourage, if you're thinking about buying in the next year, I recommend you contact us, but if it's not us, a reputable full-time professional mortgage banker, and have a conversation with them at least 3 to 4 months before you're ready to buy a home.
Of course.
That way, in case there's anything that's off, maybe there's something reporting incorrectly on your credit report, we've got time to fix it. If you come to me and you've got a contract in hand and you got to close in 30 days and I find an error on your credit report, it becomes a little bit more complicated. We can deal with it, but it's much easier if we have a little bit of time to deal with those type of issues. So,
yes.
We encourage people to get to us sooner than later. Give me, you talked a little bit about investment properties, and I know it's always, people are always thinking about, should I invest in real estate? Is that a good investment in your estimation today?
As a whole, yes, I think it is. But again, you got to look at your individual circumstances. But just for an example, what you're able to do with real estate investing is you're able to leverage. So say you have $20,000 and you put it in the stock market, and say you get 10%. That's $2,000, pretty good, right? You take that same $20,000, you put it towards a $100,000 house, you make 10% on that, you're making $10K. You're making 5 times as much money. And say you only make half that interest, you're still making $5,000. So there is, like I said, you've got to make sure it's the right situation and things like that. But there's you can use other people's money.
Yeah, and that's the key, using other people's money. That's what we're here. We are other people's money.
Correct.
Come use our money. So.
Correct.
You know what, Brian? The time goes by so fast whenever we do these interviews. I really appreciate you coming out today.
Thank you for having me.
Like I said before, I've known Brian for a long time. I know he's one of the true pros. Patrick, thank you for coming on today.
My pleasure. Thanks for having me.
We're super excited to have you part of the team. So with that being said, we're already running out of time today. Make sure you tune in on a weekly basis. Get your education. We're here to help you. Contact us, 813-517-0795. Thanks very much.
You've been listening to the eMortgage Management Hour every Sunday at 11 a.m. on 1250 WHNZ. If you'd like to contact Scott Pendleton, you can call him at his office weekdays at 813-517-0795. That's 813-517-0795. Or for more information about eMortgage Management, click on tampabay.emmloans.com. Thank you for listening.